Is 2025 the year when we double down on the stock market, or should we wait for the stock market to collapse before we make an entry? In today's video, I'll be discussing my personal strategy of investing in 2025. So let's get started. If you are new to this channel, my name is Navjot and my mission is to retire 1 million immigrants with $5 million. And if you want to be part of that mission, all you need to do is subscribe to the channel so that you do not miss any videos, because these videos will make you a lot of money. In today's video, we'll be talking about my investment strategy for 2025. I'll be talking about the stock and ETF strategy, how has it changed in the last 5 years. I came to Canada in 2020, it's 2025 now. I'll talk about all these 4-5 years, how it's changed, where and how much am I investing in 2025. We'll be talking about that. I'll also be talking about my cash position of 40%. I'll be talking about what it constitutes, why is it 40%. I did make a video last week on Warren Buffett's cash position. Now obviously I'm not Warren Buffett because I don't have billions of dollars invested or billions of dollars in cash, but I'll talk about the cash position and why I am maintaining that and what I'll do with that money if and when the stock market collapses. And fourth is my real estate strategy. Obviously, I'm in real estate. I understand that. I love it. And therefore, none of my investment strategy can be complete without talking about real estate. However, this year is more about investing in the stock market for me personally and less about real estate. We'll talk about that. Let's talk about the stock and ETF portfolio and how has it changed from 2020 to 2025. So we came to Canada in 2020. It was peak of the pandemic. And at that time, I was still learning the stock market in North America because it's so new to me. I've never, lived in North America. I've never even visited, Canada or the US before. And therefore, I was just learning, and I was learning about, these ETFs in Canada, and, all that, was very new to me. And therefore, I took the safe route of investing 75% of everything that we were investing. And we were investing very small amounts. I think it was $1,000 at that time into the Canadian stock market, into Canadian ETFs, and then 25% of the money was going into USA in a US-based ETF. I think it was at the time VFE. It still is VFE. I've maintained that, but the amount of money that I'm investing in VFE is a lot more. We'll talk about that in a bit and what VFE. And if you don't know what VFE is, don't worry. I'll be explaining that and everything in this particular video. For the first 2 years, 2020 and 2021, that's what I was doing, 75% Canada, 25% US. Then, I started to understand US a little bit more. I started to understand it's a 10 times bigger market. I started to understand, tech was growing a lot. All these tech and AI companies were doing so well. And I was like, okay, I need to rebalance my portfolio a little because Canada is very heavily, reliant on energy sector, banking sector, and very little tech. So I just rebalanced my portfolio to 50-50. And I did that for 2 years, again 2022 and 2023. It was also not a very good years for the stock market. If you have been following that, they were not very good years for the stock market. And 2024 is where I decided I need to take this seriously, and I rebalanced my portfolio even further because my trust on the Canadian economy has been reducing year over year. So it became 20% Canada, 60% US, and I added India to the mix in 2024. And 2025 will be slightly different again, where Canada will be zero, and I'll talk about that why. 80% will be US because I'm very bullish on the US economy, especially with Trump coming in power. I'm not necessarily a very political person, but I think he's good for business. 10% will go to India, so my India portfolio has reduced. I'll talk about that and why it has reduced. And 10% goes to global fund. I'll talk about which one in a bit. Now, the reason why I have moved away from investing in Canada is because if you look at the top 10 companies in Canada, it's RBC, TD, Enbridge, Brookfield, barring Shopify, which is a tech company. All the other companies are very, they're very mainstream. They are banks, they are services, they are real estate companies, they are railways. So they're not very progressive. Now, I'm not saying TD and RBC and all these banks are not progressive. Obviously, they will be embracing AI, they will be improving as companies. However, they are not scalable compared to, if you look at the top 10 companies, Apple, Nvidia, Microsoft, Google. All these companies are selling to the world. They're less than 50% of the sales come from US, and more than some of the companies actually sell mostly to the world. And that's where I feel that these companies are very scalable. They're all tech enabled. They are embracing AI a lot better than the top 10 Canadian companies. And therefore, I'm just more bullish. And it's not just about Trump, coming into the election. I'm not a very political person. He is good for business, but I just feel that these companies and therefore the US economy itself is likely to do a lot better in the next coming decades. It's just my personal opinion. Do your own research, but that's the reason why why I am not personally investing in Canada. So other things that are changing, obviously, my Canadian investments are going down to zero because I feel that US will outperform Canada. You can have a very different view, but that's just my personal point of view. My monthly investing budget is increasing from $2,500 per month to $5,000 per month. And the reason why I've been doing this is, if you have followed my videos from the last couple of months, I made a video on retiring with $5 million. I will link that video in the description. And there I made an entire plan on how I plan to retire at 57. I'm 37 right now. I just turned 37. So 20 years down the line, I want to pay off my primary home. So that's the plan for that. Stock market, I used to invest $2,500, but I figured that if I take a conservative 8% year-on-year return, I may not be able to retire in 20 years. I'll require about 25 to 27 years of investing $2,500 per month. So I'm just accelerating that. And thankfully, my income supports that. I'm not saying you have to invest $5,000. That's definitely not what I mean. If you can, that's great. If you can't, that's okay too, but we need to start somewhere. And that would give me a portfolio that I'm comfortable with at retirement when I don't have any active income. And then I have a real estate plan as well. Now, the reason why I have this slide is just to show you that this is part of my 5 million retirement plan. And this video is there in the description. I would highly encourage that you watch this video for more context on this. The third thing that is changing is my individual stock allocation has increased now from 0% to 20%. Now, I am not a huge stock guy. I can't follow news, but during the course of last 2 years, I've met a few people. I've been in a few masterminds. I've been involved with a few people who do really well on individual stocks, and therefore my knowledge on that has improved a lot. I am part of certain groups where there are signals that are being made. Now, I'm not making, investments or bets on penny stocks. I'm not doing options trading. I'm not doing any of that. All I'm doing is learning about companies that I'm very passionate about. I really feel companies like Google, Meta, all these companies are I believe that they will be companies that will be pretty big in future. They are actually changing the phase of how the world actually changes. And therefore, I would be investing 20% of all my investing budget, which $5,000 multiplied by 20% is $1,000 a month, into blue chip stocks. And I'll talk about that as well. And fourth one is I'll be holding 40% cash. I've never held a lot of cash in my investing account. I will be holding that because I do feel that there is scope for correction in the market, if not a crash. And I talked about that in my previous video. 2025 strategy, $5,000 a month. Which stocks am I investing in? The first one is 40% of this $5,000, which is $2,000 a month, is going towards US top 500 companies, which is S&P 500. And the ETF that I invest in is VFV. I'll give my reasons for why I do VFV versus VOO in a separate video. But VFV is essentially, if someone doesn't know what S&P 500 is, it's basically investing into a fund, essentially, that invests into the top 500 companies of US. So it's the most closest that you can get to investing in the US economy. And the fund that I'm investing from is VFE. This is actually listed on the Canadian Stock Exchange. So that's my biggest investment, I would say, on a monthly basis. The second one would be global tech, because like I said, I do believe that tech is driving future. All these companies like Apple, Microsoft, Nvidia, they're actually shaping the world right now. And I want to double down on technology. Obviously, a lot of these companies, I'll talk about that as well. A lot of these companies that I will be investing through this particular ETF are also included in S&P 500. But global tech leaders, the ETF that I'll be investing is TEC.TO, and this is also listed on the Canadian Stock Exchange. The third thing that I'll be investing is India Large Cap Nifty 50. Now, ESG leaders, I'll explain that it's slightly different from actual Nifty 50 that you have. The ETF that I'm using is ZID. It's a BMO ETF. Now, the reason why I'm reducing my weightage towards India is purely because not that I don't trust India will grow. I really feel that India will grow, and that's why I have it in my portfolio. However, the fees involved with investing in India ETFs sitting in Canada is a lot higher. Now, if you want to invest in India directly, and if you have the means to do that or the time to do that, I would highly encourage that you do. Maybe I would have done a little bit more than 10%. Maybe I would have like did the same that I did last year at 20% of my portfolio. However, I do not have the patience or the time to invest in India directly, and therefore I've just I just invest in an ETF, an India-based ETF, which is listed on the Canadian Stock Exchange, which is ZID. It's a BMO ETF with reasonable fees. I'll talk about that in a bit, but $500 goes towards India. And then I have just segregated the 20% that I used to invest in India, and half of that now goes towards the global value factor, which is the global ETF, VVL. It's also listed on the Canadian Stock Exchange. All these ETFs are actually listed on the Canadian Stock Exchange. So $4,000 out of the $5,000 all are, even though they are, like global markets, not Canadian stocks or Canadian ETFs, not investing in the Canadian market. They are all ETFs that invest in the US market, but they're all listed on the Stock Exchange of Canada. We can talk about why I do that, but yeah, that's something that I'm most comfortable with from a taxation point of view. And the last one, which is the remainder of $1,000, like I said, I'll be doing individual stocks, and there'll be blue chip stocks: Nvidia, AMD, Microsoft, Tesla, Costco, Dollarama, Amazon, Google, Meta, Apple. All of these stocks I have a little bit, except for Tesla, which is my second biggest holding right now because it's doubled in value. I invested at about $210 a share on average, and yeah, the stock has just doubled. Now, do I believe that it's worth double? No, right? So like in 1 year, it's doubled. It just happens to be my second biggest holding now after VFV, which is crazy. But yeah, those are the stocks which are on my watch list, and depending on which stock I feel is undervalued, and that requires a little bit of study, that requires a little bit of following the news, and if I feel that in that month, none of these stocks, and these are very specific stocks, right? None of these stocks I feel are undervalued. I just invest that money into one of these funds. Mostly I would do it in the S&P 500 because it's the safest way of me not trying to pull my hair on where to invest my money. When in doubt, invest in the S&P 500. If you want to follow my stock moves, I would highly recommend that you follow me on Blossom. Blossom is a social investing app. This is how it looks like. If you open the app, the link is in the description. This is not a sponsored video per se, but I am an ambassador of Blossom. I love the founders. They actually came on my event as well. I have been to many of their events as well. A Canadian in a T-shirt is one of the investors. Adrian is one of the investors in that company, and I just love what they have built. They have over 200,000 investors in this particular app, and this app is amazing. You can actually go to my profile. If you open any profile, you can just go to my profile. You can look at my holdings, like VFV, Tesla, XQQ, how much am I investing, what's my return. You can look at my all-time return. You can look at the posts that I have made. I do post, not very often, but once in 2-3 months I do post here something relevant. You can actually look at my trades, right? So I invested in AMD recently. I sometimes share my rationale as well around that. There are certain discussions that happen. I invested in ZID. So everything is really open. That's what I love about this fund. And if you go to portfolio, and this is my TFSA portfolio and a little bit of RSP portfolio, the problem with this one, I just feel that, I'm not able to connect it to my business account because I do invest through my business as well. But it's pretty good, right? So if you go to the homepage, you can actually look at other investors, what they are doing. They talk about, a lot of things. You can actually search for different stocks. Let's say I do VFV here and I do stocks, and I want to look at what the stock has been doing, the share, what's the yield, this is my return on this VFE stock. Then what are other people talking about this? How many people are holding it? How many people are selling it? You can actually look at other stats. What's the AUM? What's the dividend yield? You can look at the sector weightage as well. This is something that I really love. And then you can look at the dividend yields and different things about this particular stock. It's just such an amazing app. And if you are someone who is new to investing, there are multiple courses, all free. You talk about financial metrics, they talk about personal finance, they talk about trading. There's so many different things which are available on this market. You can actually also look at the earnings calendar. So which company is coming up with their earnings? Like I know that Tesla is now coming up with their earning on January 24th. Same with Pfizer is coming on January 28th. So it's really, really amazing as an app, and I would highly recommend that you download this. The best thing that I like about this particular app is is that it's really open. You cannot, as an investor, if you see someone on internet saying that I'm investing this amount of money, there's no way to check whether they are doing it or not. This particular app connects your brokerage to the app. You can not only track your own insights, but you can actually search me or any other investor that you follow and see what they are investing in. And every trade is recorded there, and the person who is recording that trade, or the person who is making that trade, can actually write the rationale. And I do that very frequently on this app. So if you want to follow what I'm investing every single month, especially on the individual stock side, because that strategy is not set in stone. The other $4,000 are set it and forget it, but that strategy of individual stocks is not set in stone. If you want to follow that, I would recommend that you download Blossom. The link is in the bio. Now, what I would want to do is I would want to break each of these ETFs and what these ETFs actually entail. What are you really investing in? So let's look at, and for this, I do use different tools to look at, the various stocks. But if you want to use a free tool, I would say that you just go to Yahoo Finance. Now, not my favorite, app. I don't think it's very accurate numbers wise sometimes. I just feel that, different websites will have different numbers, but I just feel this is a very good starting point. So VFE, it's listed on the TSX, which is the Canadian Stock Exchange. I can look at, various data points. What I would want to go here is holdings. And if you go to holdings, you would know what is the sector weightage. Now, which sector is this particular ETF investing in? So 32% is technology, 13% is financial services, 10% is consumer, healthcare. It's a very good, I think it's a very good spread. And it is, like I said, a very good representation of investing in the US as a country. What you can also look at is which companies, does this constitute. So for example, VFE, if you are invested just in VFE, and obviously, this is VOO because VFE is nothing but, a Canadian version of VOO. It's the same in terms of weightage. 34% weightage goes to Apple, Nvidia, Microsoft, Amazon, and there is a percentage asset allocation as well. 7%. If you invest $100 in VFE, that basically means that you invest $7 in Apple, which is great. You don't have to research about Apple. This list will change based on results, based on market cap, and you don't have to bother about whether the top companies are still there in VFE, because someone else will do that for you. And that's the reason why I really love investing this, and that's where 40%, at least 40% of my portfolio lies. The second one that I am investing in is Tech.2, which is basically a TD ETF. It's TD Global Technology Leaders Index. I'll talk about the numbers, the expense ratios, what it costs to invest in these ETFs in a bit. But let's just look at the holdings here. You can do all sorts of things here. But here, what I like about it is, like, if you remember the VFE, it was 7% Apple. It's much more. If you remember, the technology weightage in VFE was about 32% for technology. It's 64%. So I'm doing nothing, and there's a lot of overlap here. If you look at all these companies, these companies will also be there if you invest in VFE. However, you are actually doubling down on technology. So the only reason why I'm investing in tech, this particular ETF, is because I want to double down on technology more so that I'm doing in VFE. That's the only reason why I'm doing that. It just invests a lot more into these stocks than VFE would. Now, last year, instead of doing this particular ETF, I was doing something else, which is called XQQ or QQQ if you are investing directly in the US market. And this particular, ETF is basically NASDAQ, top 100 companies. These are all the non-financial companies. And again, if you look at this holding, and I'll talk about why I changed this year from this to another one, is again, Apple is 9%, Nvidia, Microsoft, same tech companies, but the weightage of these tech companies is a lot lower. It's 52%. So technology is not 65% that you saw in TEC, but technology weightage is about 52%. And because I want to double down on VFE, I just felt that TEC is a better representation of doubling down on technology versus investing in QQQ, and that's why I've made that minor change this year from last year. So that's VFE and TEC. Now let's look at the third one, which is ZID. Basically India ESG companies. Now ESG is basically nothing but environmental, social, and there's a rating that is given to the companies. So don't get confused. It's not exactly Nifty 50. I'll talk about that in a bit as well. But I just like the holdings in this particular ETF. It's HDFC, Reliance, Infosys. It's very well balanced when it comes to financial services versus consumer versus technology. Versus if you are investing in something called as XID. XID is exactly Nifty 50. It's all the top 50 companies. If you are investing in that, I just felt that the holdings, if you look at different companies here, very much skewed towards financial services. It's about 34-35% financial services. Plus the ESG index ZID also has companies like Zomato in it, whereas in this I don't see Zomato. So not a lot of difference between XID and ZID. ZID has historically given more returns. Now, I'm not investing in ZID because of that. I just feel that ZID is a much wider representation of the India market as a whole. Plus, I'm only investing 10%. If you want to invest more, then you can go for XID if you want to really go for Nifty 50, or you can look for a small cap or a mid cap fund, or you can invest directly into India as well. But that's just my personal choice. I just feel that ZID is a better representation of the India market and it has a better spread versus if I invest in Nifty 50 directly. The fourth fund is the global fund, which is VVL. That is another 10%, $500 per month that I'm doing. It's called Vanguard Global Value Factor. 68% of and I've just opened this here, so 68% I think of this fund is still US. So you're still investing 68%. If you're investing in VVL, you're still investing in US, but you do get exposure, about 30% exposure to the international markets as well. If you look at the spread here, again I'll go to holdings. There's AT&T, Fox Corporation. You will not see a lot of these tech companies because I've already double down. You'll see a lot of financial services, but global financial services. You will look at some companies like Shell, Exxon Mobil that you'll not see. British American Tobacco, which is a London-based company. So you'll see a lot of non-tech here. In fact, technology weightage in this particular global fund is just about 6%. So I just feel that this balances my portfolio a lot better. Not just balancing it out of the US, but also balancing it out of tech. And that's where I felt that it will be good instead of investing 20% all on India, it would be good to separate 10% into India and then 10% into a global fund. So those are the $5,000 that I'm investing. I've already talked about the individual stocks. Now, these are just numbers. Honestly, don't get scared with this. I'm just trying to compare 1 year, 3 year, 5 year, 10 year, year-on-year growth for different alternatives that were there. For instance, if you invest in VFE versus VOO, VOO is S&P 500 listed on the US stock exchange, and VFE is S&P 500 which is listed on the Canadian stock exchange. You'll see that the 1 year, 3 year, 5 year, 10 year return are a lot different. In fact, 1 year return is it's crazy. That doesn't mean VFE is better. I'm not saying that. That's not why I invest in VFE. That just means that the Canadian currency depreciated a lot more, and we all know that, and that's where the return was a lot different. The dividend yield is in fact higher for VOO, and the MER, which is management expense ratio, that is a lot lower. So you spend a lot lower investing in VOO and you get better dividend yield, and long-term growth is pretty much comparable. Now I'm aiming for a 8% growth. If I get a 8% growth at $5,000 a month for the next 20 years, I can retire well. This is giving a long-term 10-year return of over 13%, which is amazing. So that's my choice, but those are the comparison numbers if you are interested in that. If you look at the tech indexes, obviously I've chosen the second one here, which is TEC.TO. But if you compare it with QQQ, which is the NASDAQ 100 index, you will again see that the returns are slightly better. And that's because tech has actually done very well. And this particular, the second one, doubles down on tech. It was about 64-65% weightage to tech stocks versus Nasdaq, which is about 50%, and that's where it has outperformed. Tech.to has outperformed QQQ, and I feel personally, and this is just again a personal opinion, I feel that in future as well, it is likely to outperform QQQ. But that's just speculation. Do your own research. The dividend yield is a lot higher in QQQ. If you are going for dividends, then probably that would be the stock to go for, but it's not significant. 0.55 is nothing. And most of these tech companies actually invest their profits back into their business, and they don't pay a lot of dividends. And that's the reason why if you invest heavily on tech, you will not get dividends, but you will get higher growth. And MER is a lot lower for QQQ because it's a much larger fund, but Tech.to is slightly higher MER. Now, if you look at the management expense ratio, anything between less than 0.5%, 0.6% is good. The lower, the better. But yeah, 0.39%, I can live with it. If you look at India, I have just compared XID and ZID here. XID is Nifty 50 and ZID is slightly different. It is the environmental, social, and I am forgetting what G stands for, but it's just an index where the companies are rated, and it is very comparable. Slightly better on ZID, and that's probably because there are certain companies like Zomato and certain tech companies also involved in this. But the reason why I'm investing is not because of bigger returns. I'm just investing because I just feel it's a better representation or a better spread that I am looking for. The dividend yield is slightly higher for ZID. The expense ratio is lower. That is probably one of the reasons why you should look into ZID over XID. There are other funds as well that you can look at, but my choice is ZID again. And VVL, which is Global Value Factor ETF, if I compare that with ZID, because I was like, okay, should I put 20% into ZID or should I put 10% into ZID versus VVL? And I felt that the returns are comparable, the dividend yield is higher and the MER is lower. And I just felt, the numbers, at least looking at this slide, do warrant for splitting my 20% into 10% into India and 10% into the global markets. Those are just numbers, they can change. Do your own research don't just go with these numbers, just look at the spread. It's very important that you look at what you're investing inside, and go to Yahoo Finance or any other website or source that you are interested in, and make sure that you are investing in the right mix of stocks. It's not just about investing based on MER and dividend yield. It should be the right mix of industries and stocks. Now let's talk about the vehicles and platforms. When I say vehicles, you have different places where you can invest. You have registered accounts, which is TFSA, FHSA, RRSP, then you have RESP and non-registered accounts. I have made an entire video on comparing all this, so you can watch that from the description. I'll not go into those details. My strategy is simple. I would max out TFSA and then I'll invest into the non-registered accounts. I don't do a lot of RRSP, and the reason for that is because I'm self-employed, and if I take a dividend and I take a small salary and I don't have enough RRSP room, plus because I take a small salary from my business, I really don't have to do any tax savings. RRSP, the biggest advantage is that your taxable income lowers. This strategy might change when I take a bigger salary, but right now my strategy is to max out TFSAs and then invest through the non-registered account, either through my company or through my personal account. If you want to understand more in detail about this, I've made this video where you would actually get a decision tree of what to do when. The important thing is that you invest. This is just a more, it just makes your investing a little bit more tax efficient. In terms of platforms, I use Wealthsimple. In the next video, I'll be talking about why Wealthsimple over Questrade. The other thing that I like about Wealthsimple is also that it allows for me to auto invest. If I have to invest $2,000 in VFV and if it buys 7.2 shares of VFV, I'm fine with that because it allows for fractional buying. Auto investing is a lot easy. I can just set it and forget it. I don't have to go every month and invest manually. The other thing that I would highly recommend is for analysis, for talking about finance, talking about different stocks, portfolio, community news. Blossom, like I said, is amazing. I would highly recommend that. And the link to both these apps is in the description. These are probably the only two apps that you need to start investing. I will be making my next video on how to invest in US stocks using Wealthsimple without paying the 1.5% exchange fee that you have to pay because that becomes very expensive both on buying and selling. I'll talk about that in my next video, so do subscribe to the channel if you have not done that so that you don't miss that video. Now, like I said before, one thing that we have not talked about is my 40% cash holding that I am keeping just in case the market drops. And so what that does is $5,000 per month that I'm investing into 12 months, which is about $60,000, which is my target to invest on an automated basis. Obviously, I'll be looking at the stocks, the $1,000 per month that I'm doing. Apart from these $60,000, I've also kept $40,000 separate to invest as cash. And the reason why I'm doing that is if the stock market crashes, I want that liquidity to invest into stocks that I love, stocks which are undervalued at that time. time, or if I don't understand stocks at that time, I can just invest in the index, which is S&P 500, because if stocks go down, if the market crashes, even the S&P 500 will come down. So it will be a good opportunity to enter. At that time, I'm not a huge fan of timing the market. I'll talk about that in my next slide. However, I have a pretty decent budget to invest in the stock market this year, and therefore I can do $5,000 per month, plus I can keep a little bit of cash. So overall, my investing goal is about $100,000 in the stock market. If I do really well in my business, I'll probably double this mid-year, but my allocation would remain kind of the same. Now, I keep my cash in a high interest savings account, which is cash. CASH. It's a Global X high interest savings account. It's giving me an annual dividend of 4.37%. I can keep my money into EQ Bank as well. It gives about 2.5% return. You can do a GIC as well. You can do whatever you want. I personally like keeping my money into a high interest savings account ETF, so that I can just move that money around. I can just sell cash, which is the ETF, and then buy a stock that I want. It just keeps my money into Wealthsimple. Plus, I get premium for free, because if you have $100,000 invested or in Wealthsimple, you get premium services for free, and I'll talk about those premium services as well in my next video when I talk about USD investing. Should I wait for the market to come down first? I told you that I'm not a huge fan of waiting or timing the market, and I'll tell you why. If you look at the last 20 years of the stock market from 2005 to 2025, that's S&P 500 for the last 20 years. Let's say in 2007, there's person 1 and person 2. In 2007, January, before the stock market collapsed, before the subprime crisis, this person started investing. Let's say this is you investing right now. Let's say that person started investing at the peak of the market, and you'll see that the market actually dropped to almost half in 2 years after the subprime crisis. But let's say he started investing $1,000 per month every single month in January 2007, versus person number 2 was superhuman, and he was able to time the market, and he started investing in January of 2009 at the lowest of the market. And this guy also started investing $1,000 per month for, until now, he's still investing $1,000 a month. In the first case, person number 1, if he invests $1,000 per month for 18 years, 2007 to 2025, he would have invested $216,000 into the stock market. Today's worth of that money would be $663,000, and the year-on-year return will be about 11.5%. Not bad for 20 years. Same way, if you look at person number 2, $1,000 per month in 16 years, he would have invested $192,000, because it's not 18 years, it's 16 years. Today's worth will be $550,000 and a little bit more, and the year-on-year return will be slightly higher to 12.2%. So even if the second person invested and was a superhuman, and he was able to time the market perfectly, and then did the same thing that the first person did, that is invest $1,000 every single month, his return is not significantly better, or the first person's return is not significantly worse, because timing the market is not important. It's time in the market which is critical. You have to keep investing consistently, and if you do that, even if you invest in the market today, and in 2025 the market crashes to half, 20 years down the line, you'll not be very far away from someone who times the market very well. In fact, if you look at this person invested $216,000, this person invested $24,000 lower, because he started investing 2 years later. Person number 1 is way better off. Yes, the return was slightly lower, which is still great, 11.5%, but those $24,000 have returned him $100,000 plus more than person number 2. So as long as you're investing the money consistently, it does not matter whether you invest at the peak or at the bottom, because you're investing for long term. And if your goal is to keep yourself invested for 20, 30, 40 years, does not matter whether you start today or tomorrow. And finally, my real estate strategy for 2025 is very, very simple. The first one is, and again, I talked about this in my 5 million retirement video, $15,000 put into my primary home. That's really important to me. So I'll be putting $15,000 on my birthday into my primary home, hence paying off my mortgage almost 7 years early. One investment property with net operating income of $2,500 per month in Calgary. Now, I have made a video on how to buy your first investment property. I talk about net operating income. Net operating income is nothing but rent minus your expenses for that property, and those expenses does not include mortgage. The reason why I do not include mortgage while calculating, or writing this line is because in 20 years, because it's part of my retirement plan to have an investment property or have 3 investment properties, I want to make them mortgage free. And therefore, as long as you are investing in an asset that is giving you $2,500 per month in net operating income minus your mortgage, you are okay, because at the end of the day, at retirement, you would want this investment property to be mortgage free so that you can enjoy the rent and live off that. I have explained all this in my How to Buy Your First Cash Flow Property in Canada. The link to that is in the description below. And the third one is I want to build a team in Texas, which is in the US, in 2025 and invest in Q1 2026. So this is not a strategy for 2025. It's just about learning and building a team. I did invest in Ohio with partners, and I want to do that again, but this time in Texas, because I just feel Texas is a slightly better market in terms of people moving there, in terms of the tech space. I just feel that Texas could be a better market to look at. And that would be my learning goal for 2025, but I'll be investing in this market in Q1 of 2026. That's all I have for today. I hope you liked this video. Do hit the like button if you did like the video. Do share it with a friend who is also looking to see how to invest the money. Do your own research. Don't follow me blindly. I am just a random person. I am not a financial planner, and I am just trying to beat the market, which is 8-10% return. I'm not trying to get crazy returns. I'm not a penny stock guy. I have not even talked about Bitcoin here because I am not actively investing in Bitcoin in 2025 as well. I just want steady returns for the long run. That's all I have for today. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय.